Audio Jungle.
The Big Question Podcast with Chris MacIntosh.
Welcome, everyone. It has been a very long time since I've last done a podcast, and I basically actually gave up doing them because really I got too busy with managing Glenorchy Capital together with my team there and everything else in life. And so what I have just recently done was I spoke to a very good friend of mine, Tracy Shuchart, who is a fantastic oil analyst. And Tracy and I correspond regularly on a weekly basis, but, we never sit down and record anything. And so a few weeks back, we said, well, what, we should probably do this for our respective listeners. And so I sat down and I chatted to her, and hopefully you'll find the conversation interesting. And if you do, please share it with all your friends, your family, and all the people that you don't like as well. So with that intro, I'd like to dig straight into it, and I hope you enjoy the recorded call with Tracy. Okay, folks, today I am speaking with a good friend, Tracy Shuchart, who you've probably been following, and if you haven't, you bloody well should, which is Chi Girl on Twitter. And Tracy, you and I have been offline discussing all sorts of manner of things, and you've been a super valuable resource to me. So I thank you for that on the energy markets. And I figured today we'd just sit down and chew the fat on all things that we're seeing going on in the world, probably beginning with energy, because, energy is the lifeblood of a functioning economy. And it's certainly, we're in a situation where it's the most extreme and extraordinary setup that I've experienced in my professional career, and probably in yours too. So why don't we dig into that?
Yeah, looking at the energy sector, and this is coming from, I've been a bear forever, right? And so, the switch kind of came for me in 2020, after we saw that, energy prices went negative. That was crazy. But really what clicked for me was that we saw a different OPEC plus alliance, and they were more consolidated than ever, and more, after that initial scare. So we kind of saw a switch there. That was kind of a click. So I knew that we would see a lot more cooperation from them instead of everybody cheating and everything else. And then just the sheer fact that, production dropped off a cliff, you had to look at every country and know that production was not coming back, anytime soon, particularly if you look at the shale industry. We already had a lot of problems and issues going on in that industry. We were already seeing a ton of bankruptcies and mergers and acquisitions, but that really took a toll on the industry. So, I knew at that point kind of we were never going to see 13.9 million barrels again, which was basically the height in 2019. So, as you take that landscape and look at it, your production's not coming back, but demand bounced back much quicker than everybody thought, and is expected to grow, right? And then we can bring in the whole green energy transition, right? Where we have countries trying to transition too fast, which is, kind of the basis for the energy crisis that we're seeing in Europe right now. Poor energy policies, trying to transition too fast, trying to have intermittent power sources as their baseload, which is practically impossible. And then, that leads to, the greenflation topic. And I know I'm kind of encompassing a lot initially, but when we look at this new green agenda, right, and we're trying to transition and have build all these batteries and EVs and wind turbines and solar panels, etc., we need a ton of metals for these, which we don't have enough of, and then in order to produce those metals, to produce those products, that requires an enormous amount of energy, right? And so it's a very big cycle that we're in right now. I think a very big up cycle in the commodities industry in general.
Yeah, you're talking about EVs. I was just doing some research. I was actually looking last night. And if you strip out, if we take Europe as an example, because Europe's in this
Crazy,
ridiculous quandary where, the gas prices are going through the roof. Their ability to go out and source any other natural gas, say from the United States, is diminished or gone because they were outbid by the Chinese and the Japanese. And so there's just no supply, which ties into what you were mentioning with the shale. So when we had the shale revolution, you basically had excess gas supply, like tons of it. They didn't know what to do with it. They were flaring it.
right?
And that particular cycle's gone because so many people lost their shirts in the shale driven. And it was basically an industry that never really made money
Ever, right?
And so now when I look at Europe, before this crisis, you had a situation where your diesel was still half as expensive. A diesel run car was half as expensive as an electric vehicle if you stripped out subsidies. Okay. Now, I don't know what it is, but I don't need to know. Like if it was twice as expensive to have an EV pre-crisis, it's 5, 6, 7 times more, whatever the case is. It's extraordinarily more expensive because you're paying for the electricity. And then, as you quite correctly mentioned, you're not considering all of the, if we are to transition into having all these electric vehicles, we just don't have the materials that are required to have that take place. Charging times are different, weights of batteries, planned obsolescence of batteries isn't typically taken into account. And like, it's just all of this is physics. Of course, physics is probably racist today, but we have this kind of weird setup. And at a macro level, and I know we've been discussing this on some channels, when you look at what's going on in Europe, the EU, due to extraordinarily bad energy mismanagement, and this sort of implementation of this Green Deal, has to collapse on an economic front just as a consequence of these much, much higher energy costs. And they have no fallback anymore because for decades, they've been eliminating their electricity. And when I say electricity, it's basically the base load side of things, and a lot of these politicians don't seem to get the differentiation between electricity because, wind and solar is all wonderful, but it doesn't provide base load as does nuclear. And Germany just 31st of December, they just got rid of 3 of their remaining 6
Exactly.
power, and they started off with 17 back in, I think it was 2014. So they've just been eliminating the that sort of base load power side of things,
which is incredible. Sorry to interrupt, but it's incredible to think that Europe is even considering nuclear as may or may not be a green source, as well as natural gas, right? So they're still deciding, should we include this, which is just incredible to me, and very short-sighted.
Yeah. So now we have the situation where they're deep in an energy crisis. Part of I was having a chat with my good mate Kapi, and he was saying, look, from what, and I tend to concur with him. He's saying from what he can tell, it's like it looks like it's a premeditated sort of thing where if you really crush fossil fuels, you cause the rise in price, and then it justifies the green, right? Because if you can go, oh well, oil's at $150 a barrel, well, guess what? Green energy is so much more on a relative basis now practical, but that discounts the understanding of how an economy functions and the fact that you need to build out a grid, which they have not done, and they cannot actually do.
Nobody's going to do that.
So the only way that takes place is also for those green metals, if you will, to also go up substantially in price, such that the economic incentive to go and mine them takes place. And then you've got this feedback loop where it's like, no, well, we don't want to mine them because mining's bad. That's part of the whole fossil fuel industry.
Exactly.
Right? Because if you're going to mine copper, you need these giant diesel trucks. And then when you get copper out the ground, you could put it in tankers that burn bunker fuel to move it. And so the whole thing just kind of falls apart. But on what I've been looking at and going back through sort of historical periods is when you have something like this take place, extraordinary economic destruction, typically what politicians do in order to justify their own existence is they will, so in this instance, I can see them turning around and saying, well, look, this is a proof that fossil fuels is a bad thing. Look at how they're price gouging us. And we're seeing a lot of that coming through. And their response, of course, to it is price controls, which is going to have the exact opposite effect of what one would want, because it's just going to increase actual prices because it limits the supply. Because who wants to come in and operate in a market where your upside is capped and your OPEX is rising? It doesn't make any sense. So, we know what the results of that are. But what you often see, especially with totalitarian regimes, and certainly the European Union is one, is warmongering. And, when Kazakhstan hit, I first looked at it and I was like, oh yeah, energy prices rising. And I started looking more deeply into it. And I'm not convinced that that's necessarily the case. I don't know for sure. But the fact that you're seeing a lot of this war rhetoric coming out on multiple fronts now ties in extraordinarily well with this entire energy crisis and economic crisis that we're seeing. And there's a good friend of mine who runs a political risk consulting firm, and he's always made a comment. He said, wars happen when people want them to happen. They almost never happen for the reasons that you're told they happen. And then if we tie that in, it's like, I've never ever seen a war that's bad for energy prices.
That is a fact.
So we have this kind of extraordinary setup. But let's talk about base metals, because on the energy side of things, I think we certainly concur. We've got shale that's probably not coming back, not to the extent that it did sort of 2013 through 19 period was really a good sort of run for it. So many bond holders, because it was all debt financed and they all lost their shares. And so coming back, Wall Street's not going to be able to replay that game.
Nobody wants to come back either. The banks don't even want to, fund that, because they have to satiate their investors via this whole ESG mantra. So, you're just not going to see, the banks got burned the first shale run. Then you had private equity got burned the second shale run. And so really there's nobody left right now.
The only thing that I could see it potentially working is if they created some sort of ETF and they tied it in with carbon, with like some sort of carbon emission trading scheme or some bullshit like that. How they'd manage to pull that off would be like difficult, but given the ridiculous things that we've seen, I'm like, well, that could actually happen.
I just don't see shale regardless coming out. They're not going to get funding. And, if you look at what the Biden administration is doing, at the same time he's saying, I want lower oil prices, he's putting price controls and caps on, say, methane emissions, right? That's his next big thing, because the Build Back Better bill that was full of a lot of restrictions obviously is not happening, or is facing issues right now and can't be passed. So he's decided to just go in and do it by executive order. What's new? And so, all of those things are hindrance, and they're costly for oil and gas companies. So it doesn't give them much incentive to produce more, right? If they're making more money per barrel producing less, and they're going to be charged if they produce more, then, there's a reason to kind of, keep a cap on it.
Yeah. Yeah. And then, of course, we've got in the sort of corporate institutional bracket, your Vanguard, your BlackRocks, all putting a lot of pressure on the whole fossil fuel side of things, pulling back. And, what we're seeing is there's still capital, from what I can tell, flowing into the sort of, larger entities, but there's very little, like if you take that sort of tail end of oil, it's offshore exploration and drilling, and that is decimated. I mean, it's been a bloodbath, which is fantastic hunting grounds in my humble opinion. But so, and that's where the stuff has normally come from. And we're just not seeing, there's no institutional capital going into that from Western-led institutions. And so it's really leaving that entire space wide open for the Chinese and the Russians.
Absolutely. I mean, all the new projects right now are
gorging at it and picking it up for cents on the dollar.
Yeah, I mean, all the new projects right now, offshore projects, are really in Africa and South America, and primarily funded by the Chinese.
Yeah. Yeah. So we're seeing that entire shift taking place. And then if we look at the alternatives, shall we say, base metals, ordinarily you could look at base metals as an economic driver, and it's hard to make a judgment for a shall we say economic growth. You could maybe make that call from the emerging markets a little bit, but certainly in the developed world markets, it's we're in for tough times. But what's interesting is just the lack of supply that that exists in that space. Again, if you look at the previous kind of commodity bull market, it ran through till sort of tail end 2013-ish. And it hasn't been good times ever since. And ordinarily, as you kind of start seeing the supply diminishing and the demand coming back, you start seeing exploration kick in, you start seeing funding start coming through. The majors, they may start picking up some of the smaller companies in M&A transactions, and we're just not seeing a lot of that transpiring at all, and yet the prices can keep sort of creeping higher and higher. What are your thoughts on that space? And when I say that space, I guess we could probably look at it's like copper, magnesium, lithium, cobalt, manganese, nickel.
I mean, if we look at that space, first of all, they have the same capex problem that the oil industry suffers from, right? So they've had 7 years of no growth in capex, right? It dropped right off in 2013 and never, it's gone up and down a little bit, but they never gained the amount that was pre 2013. So they suffer from the same crisis as that. And then if you're looking forward to, say just demand in general, I think that they were talking about, like, in order to have enough lithium for what countries say their EV goals are by 2030, taking green bushes, say in Australia, which is one of the largest lithium mines there, basically we need 20 more of those. And we don't have those. we don't have that. We don't even have that in the pipeline. whatsoever.
No.
So I mean, and that's the same thing, it's the same thing with copper, and it's the same thing with basically all of these metals, aluminum, cobalt. It's underfunded. What's interesting to me is that, before, everybody kind of looked to China as the main driver of the demand in these metals, and I think and judged it as, is the economic growth, right? Dr. Copper, right? Is that the health of an economy if it's the market's going up, right? But I think what's interesting, and I've been talking about now for a couple of years, that, I don't think China is going to be the main driver of these metals anymore with this green agenda and with this transition. And we're going to see a lot more demand come out of the West. So even if we do see China slowing a bit, I don't think that's going to impact demand as much as it would have in the past. And what's interesting, and on another note, what's interesting is I was just looking at, what happens to metals when Fed funds raise rates. Basically, just raising rates, they rise, right? Within the looking forward 12-month period. They rise by about 30% if you take an average of all the last hiking cycles, which is also very, very interesting. So we're kind of headed into perhaps a hiking cycle now. I'm a kind of one and done on that one, but if the Fed raises rates as much as the market is saying that they're going to raise rates, it does happen to be very bullish for metals, and copper in particular.
Yeah, it's your classic stagflation, right? Because when you understand that in the commodity space, it's a debt-driven market, right? You think about an oil rig, go and put an oil rig out there, like no expensive. And so much of that entire industry is debt financed. And it's debt financed based on a longevity cycle. So like you might say, okay, we're going to go out and we're going to do X, Y, Z, and it's going to take us, let's just say 5 years or 7 years before we actually get the actual production stream online, like this, if you're kind of woe to go on, say, a mine. And so you need to amortize out what you think it's going to look like over that time frame. And so if interest rates are rising, you could have rates go up 1%, but you're gonna, if there's, as soon as you move into a market environment where the market anticipates ever higher rates, it's not your base rate that people are looking at in these long time frame markets. What they're looking at is what it's likely to be in 5, 6, 7 years' time, and they then begin pricing that in. And what it does is it eliminates a lot of projects, which would otherwise be economical based on current market data. So you might say, okay, copper price is X, interest rates are Y. Let's work it out. Yes, that's profitable. But what you're doing is you're saying, but hang on, rates are rising. So yes, they're X, but we think they're going to be X plus 4% or whatever the case might be over this time frame. And hence our Y variable changes such that we need a copper price that is Y times 3.
Right.
Or something, so then you go, okay, we're not doing it. It's too risky for us because we need to make sure that our bondholders can be paid out and we can keep this thing alive and everything else. And so you kind of move into the cycle, and then constriction and supply then feeds into a situation where there's less supply, higher prices, and as the prices go up, typically you've got this environment where you've got inflationary pressures, and then the Fed or the ECB or whoever the central bank is are trying to contain those, so they hike rates even more.
Exactly.
And so then your quant sitting there go, we thought it was Y plus 4, it's now Y plus 5. And so you can really get this real squeeze in a market, which is trying to price probabilities out over a cost curve that's multi-year in nature. what we've always had that, but we've never had it to the extent and the extremes that we have it today, as a consequence of the green agenda, as a consequence of global shutdowns, supply chains breaking down, and all these other fun things that have been taking place. And so one of the things that we've been focused on, and I know you've been tweeting a bunch about it as well, is how this all feeds through into food production and cost of food.
Absolutely.
Which, given that you're in the sort of gentler version of North Korea at the moment, where there's the mandates to halt all trucking coming in from truckers that are not vaccinated. I just saw a video last night with a trucker, and then I followed that up and I spent some time. I don't know for sure, and maybe you can help me on this, but it seems that the basic numbers that it looks like right now are that roughly 50% of those truckers are unvaccinated.
Correct.
And of the fruit and vegetables, roughly 90% of that supply comes from the United States.
Correct.
So what you're looking at is possibly 30-40% of supply being shut off overnight. What are your numbers looking at?
Completely.
Is that?
Yep, that's correct. That's exactly. I mean, I've been tweeting about it. I've been writing about it as well. But and that's just fruits and vegetables, in Canada during the winter, right? But that extends to, it's not just food, right? It's also automobile parts. It's also oil and gas to some extent that's trucked. Not all of it, but there is still oil and gas that's trucked over the border. That includes any building materials, right? Lumber prices, we just saw incredible rebound, right? From, we were at 1,800, fell to 500. Now we're back to, I think, 11 or 1,200, right? And US gets most of its lumber from Canada, from British Columbia. So that's going to add fuel to the fire in that industry. I mean, it's going to, it affects more than just food, and it's incredibly self-induced. Like there is no reason. For 2 years, truck drivers were considered essential drivers, and they didn't have any restrictions. And suddenly they have restrictions at the oddest time, when we are seeing a lot of the world kind of backtrack on or let's say UK, for example, today got rid of all or is getting rid of all the restrictions. So it's very interesting time that suddenly 2 years within this, you're going to decide to stop industry over vaccines.
It's fascinating to watch, because you're seeing completely opposite trajectories being taken. Mexico dropped all of their restrictions at the same time as Germany and Austria and Italy ramped up their restrictions. Canada, as you know, is going complete full retard.
Yes.
Australia, same sort of thing. And so, on a geopolitical kind of macro basis, these are really, really interesting times, because it's not just sector driven. It's not like, in the past, we could look at particular sectors. It could be biotech, it could be energy, it could be whatever, from my perspective, being, a macro fun guy, I'll buy anything. I'll buy baked beans if that makes sense. I'm agnostic,
right,
to, some sectors. And, for many, many years, we weren't in energy, and now we're balls deep in it. Like and so call me in 10 years time, we'll probably be in something else. But what I've never had before is kind of this geographical dispersion taking place that's just so extreme. And that exacerbates the underlying sectors themselves, right?
Right, because you're disrupting supply chains, but in an uneven way, right? I mean, we already have supply chain disruption anyway, right? And that's still not fixed. But now, you're having this, uneven like push pull that's affecting everything. I mean, if you look at how interconnected, for example, the US and Canada are, say for NAFTA, like take our automobile industry, for example. I mean, Ford, and Chevy and all the big American companies, I mean, have plants here in Canada. They go back and forth with what they make in order to actually put a car together, right? I mean, there's parts of going back and forth everywhere. Same with Mexico, but I mean, I think we're in for trade in North America is going to, I think, start suffering kind of some of the crisis that we're seeing in Europe right now. But I don't think North America, I mean, is immune to the energy crisis or supply chain crisis within the continent.
Well, it would be less susceptible, I guess, if domestically and internally you didn't have the same pressures of breakdowns in supply chain. So, if you look at the restrictions just within the United States, each and every state is quite different.
Right.
And so moving goods and services around in New York now is vastly different to doing so in Texas or in Florida. And you're seeing that. So it's almost like we can't even take these, what we previously looked at as countries, and say, okay, that's doing X, and we can we can map out and go, okay, they've got this and this and this and this, and their supply chains are broken in these different parts here, and where else could they source this? And we started doing this back in sort of March of 2020, when we started seeing the shutdowns. And I immediately started, I got a whiteboard here, and I started mapping out the world and going, okay, where are the supply chains for what goods and services? How are they going to likely be impacted? And what are the second, third, fourth order consequences? And you could, trying to just get an understanding of what that looked like. And at the time, we were looking at geographic countries and then looking at trade agreements, right? And you could say, oh, Canada. And at the time, you could have said, you know what? North America is fine, pretty much.
Right.
Largely, okay. Fairly self-sufficient in energy. I mean, just food, navigable rivers, the whole lot. It's like they're pretty much okay. Europe is a little bit more difficult. Asia's, so you could look at that. And now what we've moved into is within each country, you've got the splintering and factioning.
Right.
And so in the United States, you're almost now redrawing all of that and going, oh, I mean, I've literally been doing it with some friends. We were sitting and saying, okay, let's play the theoretical game and say the US splinters into 2 or 3 different, it doesn't have to be countries, or just economic structures.
Right.
Your Texas, Florida, Tennessee, Idaho, basically the red states, what do they have? And because the likelihood is that they're going to be more free to trade with one another on state lines and so on and so forth. And it's, it's just, it's incredibly disruptive to everything. But yeah, so when you, and the world that we built is one whereby just-in-time inventory has been the standard. The idea that just because you might be able to grow pears, you might not.
Get them anytime.
You can get them from Canada or from somewhere else, and they can do it cheaper. So let's just let them do it. And now that's all just getting chucked up in the air. So I think there's certainly going to be a massive drive towards more self-sustainability, just as a pure economic reality of what has to take place. But if you're going to go get tribal on it, what it means is not just production, supply, and rebuilding of alliances. It's also the protection of those goods and services. And so all of those things, when I look through all of that, it's quite deflationary on certain aspects of the market, but it's extraordinarily inflationary on others. And so often people say, are we in for deflation or inflation? And I'm like, yes.
Yeah, exactly. Stagflation. Because I think you're going to have persistent pressure in the commodities markets, no matter what the Fed does. I don't care if they're hiking and they're, that's supposed to create deflation, because there's a ton of deflationistas all over Twitter, as you well know. But my argument is, the commodities industry is, you're going to see persistent inflation there. So we're going to, hit a stagflationary area, right? And if we look back into, say, the 1970s, the last time we really saw stagflation, energy did extremely well. Metals did extremely well. So you saw commodities do extremely well. I mean, if you call very high prices extreme, but those industries did extremely well, if you're investing in those industries. And so I think that's where we are. I think that the Fed is behind the curve, as usual, and no matter what they do at this point, they are not going to stave off inflation in the areas that they really need to be focusing on. Right now, that the Fed's just not that.
So what do you, if we break down, we've got fossil fuel energy side of things, we've got so we call it renewables, alternative energy space, which is your base metals.
Right.
And then you've got the knock-on effects, which is down to like things like food. Is there anything else that you're watching and monitoring that you think is worth considering?
I mean, those are my three main themes right now, or have been for a couple of years. And I think going forward, to 2025, 2030, possibly, some of them are really agriculture, metals, and energies. Really, my main kind of my macro themes that I've kind of been writing about and investing in.
Yeah. They're the sort of obvious ones. They're also, what's interesting also is that they're fairly price insensitive in that they form the backbone of Western civilization.
Well, it's everything, right?
And without
energy, you can't do anything without energy, period. So, and you could take that, you could take just the rise in energy prices and pretty much just use that as a basis for any of your investments. If you're looking at anything energy intensive, or you can play it so many ways, right? It doesn't have to necessarily be with metals and agriculture. It affects all businesses, right? So your top of the line usually for a company is your energy costs, right? Aside from your workforce.
Yeah, I think it drives all the way through into, I was having a chat with a client who, he's over in California, and he's got a chain of dealerships that sell secondhand motor cars. And we were,
that industry is crazy.
What's interesting for him is, like he said, his business is a way better business than manufacturing, because he can throttle up and down much more easily. Like his OpEx, he can actually move as he needs to, right? So yes, he's got his fixed costs are his leases on particular lots,
right?
But then he can roll those and he can kind of move. He's got some flexibility within it, but really in terms of the demand and supply, he's got some flexibility to move, and he can adjust his prices like that.
Right.
Whereas if you're thinking about a manufacturer, like let's say your VW, like you've got all these huge fixed costs, and you're trying to project out demand, and it's like, who can figure out what demand's going to be when you've got all these governments that are putting in all sorts of restrictions or like if you make a diesel car, will it even be allowed?
Right. Or, we're
People,
going to make this many EVs. Are they even going to sell? Is there a market for it? I mean,
yep.
If you got to look at what your market is. I mean, if you look at some place like the United States, right? I mean, the United States is huge. Everybody drives, right? And so I think that EV transition is going to be very difficult for for people in the US or Canada, say, that drive a lot, because you're going to have to make it, you're going to have a longer drive period, and you're going to have chargers everywhere, right? You can't switch to something that is less convenient for people for it to really catch on, right?
And that's where the governments will often try and put in incentives or punishments to try and nudge people in the direction that they want them to. But all of that is stagflationary, right? Because it's not market forces that are driving it. It's a situation where your diesel, for example, is half the cost of EVs, and they go, well, we don't want you to make diesel choice, so we have to tax diesel and maybe put in rebates on buying an EV or whatever the case might be. So that, but all it does is it just pushes the prices up, everywhere, which is less supply of everything and less consumption. And this all comes into like what we, if you go back and you think about the previous cycles that we've had, at least in my professional career, inflation has always been basically a demand led inflation. It's been emerging markets. It was the BRICS. It was all of that. And so there's this, sort of misunderstanding, or at least not an ability to kind of think the possibilities through at the moment, where people are going, well, we're not getting that level of demand. Like China looks like it's not necessarily coming through with the demand. It's not growing. And so we don't have demand. So how can you have inflation? And all of this is just supply side.
Supply side, exactly. And that's what everybody, I think that's what all these deflationistas are, kind of how I think they're kind of, I don't want to say looking at it wrong, but they're not looking at the supply side, because it's been a very long time before we've had supply side inflation. And, it's not transitory, right? We still, nothing is fixed yet, right? Nothing's even close to fixed yet. In fact, countries are trying to make it worse. Like Canada.
Yeah, absolutely. No, we're certainly in for, I think, an interesting decade. And certainly it doesn't feel like the solutions to the problems that we've just discussed have always been and will always be opening free markets and allowing capital to move to where it's treated best. And the impediments that are being increasingly placed on that actually taking place are just exacerbating those issues. And that's why I think we've got at least probably a decade of this. And then coupled with that is we have this extraordinary situation where monetary policy is just continuing to do what they've done before, which has been loose. And now we have fiscal, and fiscal we didn't have. And now we've got a lot of fiscal, which is all along this Green Deal stuff. And that's going to have it's going to have an impact on the base metal side of things, but I think it's also going to exacerbate and accelerate that geopolitical shift that we alluded to, whereby certain countries are going to go, you know what, we're not playing that game. We're going to play this game,
right? And
other countries are going to go, no, we're doing this over here. This is the great leap forward, and everyone's going to follow.
Right. And we're already seeing that, right? We have China, regardless of what they say, watch what they do, right? They just increased their coal production and consumption this year, almost tenfold, 250 MT right? That's a lot for a year in 2021. And then you have Russia too, who's, like Green New Deal. Okay, we'll stick with oil and gas. Let's drill some more in the Arctic, right? And so you're already seeing that kind of, countries are going to do what suits them best, regardless of what Europe and the United States or Europe and North America says, right?
100%, 100%. Is there anything else that you wanted to touch on? Otherwise, I won't keep you any longer.
No, I mean, I think we're good. We covered quite a lot, I think, right?
Yeah. Basically, we're in for a lot of fun.
We're in for a lot of fun. I think, there's a lot of opportunity there. I mean, it sounds grim, but, if you're in the markets, there's a lot of opportunity, probably, the most we've seen in a very long while. Nice to get away from tech for a little bit too.
which increasingly hasn't made some sense for some time. Unprofitable companies that have benefited as a consequence of lowering interest rates continuously and pushing more and more people down the risk curve.
Exactly.
And I think that entire risk equation is getting very rapidly unwound. Anyway, where can people find you? I know Chigl, of course, is your Twitter handle.
Yes, I'm on at SCHIGRL. I also write for hedgefundtelemetry.com. I write an energy note, and then I just joined Intelligence Quarterly, where I write a metals note.
Very good. Well, I strongly encourage anyone listening to check out Tracy's wonderful material. It's excellent. She really digs in deep into all of the numbers and gets the sort of granular data, which is definitely a go-to for us. So, but thanks so much for your time, Tracy, and wonderful to chat again.
Definitely.
Thanks for listening to the show. Search for capitalist exploits to learn how we are investing for these unique times.